purpose of this presentation is to explain the sources of government revenue. Federal, state, and local governments collects about $2.8 trillion a year. That's about $10,300 for every person in the United States. Since 1940, the total revenue collection by all levels of government have increased over 800%, even with the adjustment of inflation and population growth. Taxes have a huge impact on every aspect of the economy. When a tax is levied, it affects the factors of production. People react to higher prices by buying less, which enforces companies to produce less or decrease the amount of employees working. For example, in 1991, the luxury tax was enacted by Congress to raise revenues for people who can afford expensive goods. In reaction, less people were willing to pay for these goods, and unemployment rose. Some taxes are used to adjust the behavior within a society. Taxes on liquor and tobacco are examples of these sin taxes. Sin taxes are high taxes on undesirable products such as liquor and tobacco. There are three criteria for an effective tax: equity, simplicity, and efficiency. In equity, taxes must be fair. There is no fair tax, however. The closest thing to fairness is to avoid as many loopholes as possible. A loophole allows for a certain group of people to avoid paying the tax. In simplicity, a simple tax makes the taxpayer much more likely to comply with the tax. An example is a sales tax. Everyone pays a sales tax, though some items may be exempt, such as certain foods and medical products. Individual income tax are taxed on people's earnings, which is disliked due to the lack of simplicity. Efficiency. A tax should also be easy to administer. The federal income tax is a good example of this. An employer withholds a certain amount of a given paycheck and sends the amount to the IRS. This is all done electronically now, so there is little burden on both the employer and the employee. Benefit principle. The benefit principle simply means that those that benefit from the services of the government should pay for the benefits they receive, such as Social Security. Most benefits go to those who can't afford them. Ability to pay principle. This principle is derived from two factors. Society can measure the benefits that come from government spending, and secondly, it assumes that people with higher income suffers less discomfort paying taxes than people with lower incomes. Types of taxes. Proportional tax, same percentage for everyone. Progressive tax, higher taxations for higher incomes. Regressive tax, higher taxation for lower income. The government uses many systems to collect taxes, such as payroll deductions, which are payroll taxes deducted from paychecks. And FICA, the second most important tax for both employers and employees, to pay for Medicare and Social Security, which is collected by payroll taxes. In 1965, Congress added Medicare to the Social Security program. More than 30 million senior citizens participate in this Medicare program. The Medicare plan pays for the majority share of an eligible person's total hospital bills. The Medicare component of FICA is taxed at a flat rate of 1.45%. Medicare, unlike Social Security, allows wealthy individuals to pay the same percentage of income to Medicare taxes as the poor. Corporations as well as individuals must pay income tax. The third largest category of taxes the federal government collects is the corporate tax. The tax of corporation pays on its profits. Corporation tax is separately taxed from the individuals. Corporation is recognized as a separate legal entity. Another federal tax is excise tax, a tax on manufacture or sale of selected items such as gas and liquor. This is the fourth largest source of federal government revenue. In 1991, Congress added luxury goods to the excise tax. An economic product is called a luxury good if the demand for the good rises faster than the income when income grows. Another federal tax is the estate tax. This is a tax the government levies on the transfer of property when a person dies. To avoid this federal tax, one can give away his estate before he dies. The gift tax was established to prevent this loophole. This tax is on donations of money or wealth. This is paid by the person who makes the gift. Both the estate tax and the gift tax are progressive tax. The higher the estate or gift, the higher the tax rate. Another federal tax is custom duties. This is a charge levied on goods brought in by other countries. Finally, about 1.9% of federal revenue comes from miscellaneous fees, such as user fees. User fees are charged levies for the use of a good or service.
State and local governments raise revenue in many ways. They receive funds from sales taxes, property taxes, utility revenues, and through other methods. The largest source of state revenue is the category called intergovernmental revenue. Funds collected from one level of government and distributed among another. States receive these funds from the federal government and help with expenditures on welfare, education, highways, and health. The sales tax is a general tax levied on consumer purchases of nearly all products. The sales tax is the second largest source of revenue for states, accounting for 2.7% of the total revenues collected. The sales tax is the general tax levied on all consumer purchases of nearly all products. The sales tax is the second largest source of revenue for the states, accounting for 21.7% of the total revenues earned. The remaining revenues that state governments collect are interest earnings on surplus funds. Tuition and other fees collected from state-owned colleges, universities, and technical schools, corporate income taxes, and hospital fees. Local governments receive the largest portion of intergovernmental revenue, slightly more than 1/3. So these revenues go to funding education and public welfare. The second largest source of local government revenue is the property tax, a tax on intangible and tangible possessions such as real estate, furniture, automobiles, and farm animals. However, the property tax that raises the most revenue is the tax on real estate. Tax reform in the 1980s and 1990s began with Reagan. Because he believed high taxes were crippling the economy, he proposed the Economic Recovery Act of 1981. Businesses relieve tax relief through accelerated depreciation, which means higher depreciation charges, and an investment tax credit, which is a reduction in business taxes for investment in new equipment. In 1986, Congress passed the Tax Reform Act, which ended the progressive income tax, added a 5% surcharge or an additional tax beyond the base rate, and established the alternate minimum tax, which made sure that people paid a minimum of 20% regardless of other circumstances. The reform shifted $120 billion worth of taxes from individuals to corporations. In 1990s, government spending far exceeded the revenue it was bringing in. In 1997, the Tax Relief Act, which closed many loopholes, actually resulted in more people paying their taxes. The value-added tax, which is a tax applied on every stage of production, has been proposed to increase government revenue. The advantages of this is that it is hard to avoid the value-added tax. In addition, the tax is widely spread and easy to collect. The disadvantages of that value-added tax is that this tax is invisible to customers and it adds further to the sales tax already applied on many products. A flat tax is a proportional tax on an individual's income. Now, the advantages of a flat tax are that it is simpler to the taxpayer, it minimizes loopholes, and decreases the need for tax accountants. Factors that encourage future growth are the facts that the taxes are too complicated. In the 1990s, the government had record tax collections, and economic change, as opposed to political change, is gradual.